Home Depot reported before the bell along with Walmart. We just did a Walmart video. Guys, if you're new to the channel, you need to subscribe because we do these live. We do very quick responses. Sometimes within 15 minutes of the results coming out, we have a video out. We do 2 or 3 videos a day. Subscribe to the channel. Make your life better, easier, smarter. Home Depot reported $4.24 per share versus analyst estimates of $4.13. They reported $38.9 billion in revenue versus an estimate of $38.0. Guys, welcome to the benefits of inflation. Inflation helps these companies just like it helped Walmart. It's going to help these retail places that can immediately put the price increases in place because people expect them to be there and they're going to buy what they need for their homes. So let's check out Home Depot. We're going to use our 8-pillar process. We're going to have Mo convince me that Home Depot will be bankrupt in 2 years.
And we can talk about how the stock price is going to be $300 million because of inflation, according to Paul.
That's not at all what I said. So anyhow, let's take a look at it using our software. And by the way, if you're subscribed to our software, what I recommend you doing, pause the video, go put the stock in your own stock analyzer tool before we do it, just to get acclimated to it and make your own assumptions. Mo and I just did Walmart, and we had a 5-minute conversation about assumptions on Walmart, and that's the point of investing. It's an art, not a science. You have discussions, so I highly encourage you. And if you don't want to, fine by me as well. If you have the software, just go along for the ride. So some high-level aspects. Oh, look at this. Market cap of 315 and enterprise value of 390. So even though it's a retail location with a lot of leases, this difference is usually by debt, so it's not that much different. Healthy dividend here of 2.7%. They paid out 7.6 in the last year, $1 billion. Now, if you're new to the channel, I always talk about how dividends aren't always secure. You need to compare the dividends to the free cash flow generated. And in the last 5 years, they've averaged $12.5 billion of free cash flow, and last year they did 11.2. So this is a company that pays out a big chunk of their money in dividends. Now, I can understand why. It's a very large company, not a lot of growth potential, not a lot of reinvestment potential, probably. So they got to give their investors what they want, right?
Mm-hmm, yeah.
Okay, so 2.7% dividend, pretty solid. And remember, as the stock goes down in price, the dividend yield will go up. All right, profit margins, healthy. Gross margin of 33%. Overall profit margin around 10% and very consistent. High return on invested capital. Let's go to our 8 pillars real quick.
You know they've grown earnings 10 quarters in a row.
Have they?
Yeah, pretty good.
Can I make another joke?
Sure. Inflation.
So anyhow, here is the 8 pillars. What was that?
Inflation owns your brain.
Your comment owns my brain. I can't believe we had the conversation. So Mo, what do we like about this 8-pillar chart?
Let me pull up the 8 pillars. From what I remember, yep, this is what I like. It's over the 2 metrics show over valuation, and for a change, I like their very similar. They
yes.
Out.
So on Walmart, there was a discrepancy between the ratio of earnings to free cash flow. And this is something we want everybody. The 8 pillars tell a story to us. We want to look at the 8 pillars and say, okay, what's going on here? What are the red flags? With Walmart, it was a big difference between the PE and the price of free cash flow. So the first question is, why are they reporting a different earnings and a different free cash flow number? There's a million reasons why it could be. Sometimes it's fraud. Most times it's not. So in this situation, we have check marks. Look at this return on invested capital. It's an insane number.
I don't really like that.
So that's the thing, guys. We talk about, this is one of our pillars of buying back shares. Walmart just announced a $20 billion buyback. I don't know if Home Depot, what their buyback plan is, but we don't want companies buying back expensive shares. That is a misuse of your investor capital. That's money, if this company's too expensive, that's money I'd rather have the company pay out in dividends, which can be tax inefficient, but it's better than overpaying for shares that you own. Yes, they have a dividend here of 2.4 last year and 2.7 next year. So people would say, well, they're saving that dividend. Fine. But you don't want a company reinvesting its money back into an overpriced company, even if it's their own.
So they're the same as Walmart. I just went back 20 years on the income statement at the bottom, and they have been, for the past 20 years, they've been buying back shares, even
consistently.
Going back to 2003. Yeah.
Oh, people. All right, let's see what the analysts are saying.
They're thick and thin.
Analysts. All right, EPS growth from 16 to 20. So basically a 25% increase over the next 4 years, 5 years, whatever the number is. Mid-single digit. Revenue growth. Look at this random.
I know, what is that?
Look at this random number here.
Why is that?
I mean, it's just where the analyst estimates came in. It's an average of them. But again, low single digits. Guys, inflation's going to help this out. They're probably going to open. Do not start with me, Mo. Mo, go watch the Walmart video and watch Mo and I argue on air, live, literally in person. Like, this is not scripted, guys. This is completely unscripted material.
We walk down here and we go, I usually go because I don't remember. I go, what are we doing right now?
Yeah.
What's the next video?
And then Mo starts talking about how Walmart should have 18% less revenue over the next 10 years than it does today. And I was like, what the F are you talking about? What was that?
And then you go, inflation.
You cry every morning show about the printing of dollars by the government. And I'm like, how is that deflation? You're like, oh, good point.
Years about that.
Yeah. Okay. So anyhow, let's use a stock analyzer tool. Now, for those of you who are new to the channel, our entire software is built towards analyzing companies the way you should, which is you're buying a stock, which is buying a piece of a business. And our stock analyzer tool is probably the most popular aspect of our website. Why? Because it lets people make assumptions on the future, and it'll tell you, without looking at the balance sheet, what price you should pay for the company. You can do a 1 to 20 year analysis. We're going to do 10. Now, I'm very, very scared to ask Mo to give me his numbers, but we're going to ask Mo, the good boy that he is.
I'll please both of us.
I'll please both. Okay, so Mo, low, middle, and high assumptions for the next 10 years.
1, 3, and 5.
Okay, fine by me, even though I think 1's still low.
Pleases me on the low side, pleases you on the high side.
Okay, next, profit margin, Peanut.
How about 9, 10, and 11?
Okay, I like that. Finally, next one.
Same thing.
9, 10, 11. Now, guys, here, we do see a difference. It's the same here, a little difference here, big difference here. I don't mind making a really high assumption of 11%. Inflation happens, a little bit more. They grow a few more stores, that kind of thing. Maybe they can get 11%. I'm okay with a high number being high. Like, okay, that's going to take some effort. Now, PE. The PE and the price to free cash flow ratio is for what's it going to be in 10 years? Not today, not 5. At the very end, we're coming up with an end value for the business. So we have to take the earnings and free cash flow generated in year 10 and apply a multiple to it. Historically, the average is 15 or 16. The bigger the company and the bigger the moat, the bigger the growth potential and the bigger the moat, the higher the PE. But as companies get larger and larger and larger, that growth potential gets lower, but the moat probably gets a little bit higher. Like I asked 100 people on the street, where do you go to buy home improvement products?
Home Depot or Lowe's.
And I'm sure even the majority of them are going to say Home Depot.
Yeah, probably.
Probably more so than Lowe's.
Yeah, probably right.
So, Mo, what PE do you want at the end, knowing the historical average is 15 or 16?
12, 14, 16, or 13, 15, 17.
I'd rather go with 13. Okay. How about 14 and a half and 16?
That's fine.
Actually, you know what? I like your 13, 15, 17. Even though I don't think the revenue growth number is in line with 17. But for me, I would have personally done 14, 15, 16. Because the historical average is 15, whatever. Yeah. All right, now desired return. 9 or 10% in an ETF. So to justify buying an individual stock and to have some margin of safety, you need to have a number higher than that. And the higher your assumptions, the larger your margin of safety should be. Therefore, the higher your desired return will be. Mosafine. 80, like last time, 24, 30, and $1 billion %. Mo wants Home Depot for free, by the way.
Yes, I do.
All right, what's your desired return, Mo?
12.5, 13.5, 14.5.
How about 12, 13, 14?
Fine with me.
Analyze button. Guys, the stock is currently at 310. It's up 1% today. If all there are going to be 6 numbers that pop up. If all are green, it doesn't mean go out and buy. It means go do more research. How do you do that? Easiest way, go to everythingmoney.com, join our community for less than $1 a day. It's so simple, guys. You get the thousands of people in there, like-minded. You can talk to them about your investing, just like Mo and I do. You'll probably get into some fights, just like Mo and I do. But Mo and I, after this, will hug, and we'll be fine. So, okay. A low price of $145, a high price of $240, a mid price of $190. I have it on my watch list at $185. I probably should go higher than $185. I'm probably going to change it to $200. And the reason being is I want to sell puts starting when it hits $200, but at much lower prices. So what that's going to do is it's going to allow me to get to a lower price and start selling puts using that momentum. Now, you might be sitting there saying, it's not going to get to $200. Okay. But secondly, if it never does get to $200, I never buy it. Okay. move on to the next one.
Go look at Lowe's.
Exactly. So guys, thanks for watching the video. Please subscribe to the channel and check out everythingmoney.com. Take care.